Hi, welcome back to Channel 11. I'm your host, Ken Shinoda. Today's Thursday, February 6th, and we're going to review January 2025. Let's take a look at the land of gains, the S&P 500. It has kind of been going sideways, up a little bit this year, up 3%. So our rocket ship is going sideways, and it's not a happy, not a sad, just a neutral face because the market's kind of expensive, but we're still eking out a little bit of gains. If you look under the cover, you can see certain parts of the market up a lot. Healthcare, communications, financials, that Trump trade there, energy. But on the far right, infotech, negative as you see a pullback in the Mag 7. We're taking a look at S&P 500 versus equal weight. It's just been a huge run up for S&P 500 with that Mag 7 exposure. But as those markets pull back, we see that the equal weight's playing catch up. This is a big theme people have been talking about and thinking about is it time to get that equal weight exposure? Every time it seems like that's going to work for you. That Mag 7 keeps making that huge comeback, but maybe this time's different. We'll just have to wait and see. From a valuation standpoint, the market definitely is expensive. If you look at the CAPE ratio, we're at the higher end of the local range that we've been in. We were, of course, higher in early 2000s before the big tech rout, but valuations looking on the expensive side. As we take a look at some of the more speculative parts of the market, they seem to have calmed down, just like the equity market has calmed down. Bitcoin moving sideways, ARK kind of moving sideways, Tesla kind of moving down, as well as Dogecoin. Another part of the market that had been on fire is the big AI trade, semiconductors here. The Philadelphia Semiconductor Index, stocks on a tear relative to the S&P. And even though the S&P had done really well, of course we know that NVIDIA and other semiconductor stocks had done really well, and you're seeing that kind of pull back too. So kind of question are some of the themes that we've seen, kind of like the AI theme, and what we're going to look at next is the Trump trades theme. Are some of those overdone and maybe going to move in the other direction? In the top left, Russell 2000s, if Trump's coming in with a new administration, we're going to have tax cuts and business-friendly environment. You saw a big run-up starting kind of in November of 23 in small caps. That wasn't because of Trump, of course. That was because of hopes of rate cuts. But the more recent moves up had been, I think, because of potential for better growth with policies coming out of the administration. But that's kind of moving sideways recently, and I think it has to do with the sell-off in rates was bad for the Russell. But that sell-off in rates has abated, and you're seeing yields coming down. Shorting rates was one of the Trump trades. If the policies that the administration was going to put into place, creating new inflation, tariffs, trade wars creating inflation, that was going to take rates higher. But it seems like some of these tariffs expectations are getting pulled back. The Mexico-Canadian tariffs getting pushed back a month, maybe not being as aggressive as the market thought. And that's why you're seeing kind of one of the reasons that I think you're seeing rates come down. That should help the Russell 2000 pick back up. Financials, deregulation theme, financials, I think that's one of the themes that's staying in place. So it seems like financials keep moving higher. And then the other one was the strong dollar. You're seeing some dollar weakness, I think also related to rates coming down. Now, with that, looking at the speculative longs in the dollar, this was one of the big trades for many, almost seems like years now, has been that strong dollar, U.S. exceptionalism. And if that unwinds, that could be very interesting for international equities. So if you look at some of the beneficiaries this year, it's really been international equities. Euro stock up over 6.1%, the FTSE up 5.6%. Nikkei's kind of lagged as they start to raise rates over there, but I think kind of in the long run, there's still cheaper valuations in the Japanese market than you have obviously in the US. But EM's kind of been the laggard, so that's one of those things that a lot of people have been saying, weaker dollar, EM's going to make a comeback. So it's TBD if it's really going to be a rotation to those international equities, more developed countries, and or if EM will be a beneficiary as well. Taking a look at those indices, you can see the Nikkei had a huge run up last year, one of the better performing markets. So it's kind of been moving sideways very recently. This is price of the indices. And the FTSE that had been going sideways, finally taking a leg up. Same with the Euro stocks in the bottom right, but EM still kind of lagging. So I think it's important to watch these markets. There has been a lot of people that said you just got to stay in the US. US is the place to be. But if you start seeing that weaker dollar and there's some tailwinds to these currencies, cheaper valuations, you could see global capital start taking a look at these equity markets as a place for potential future total return. This is a fascinating chart. This shows you the euro going into the last election. You can see that it's sold off into the election and then kind of like buy the rumor, sell the news type thing. And then actually when we saw the election happen and then the dollar weakened, euro rallied. So I don't know if this is going to happen again, but just something interesting to note. Taking a look at the yen, this is now, you got to kind of look at it flipped. The yen is weaker when the line is higher. And we've been, bouncing off this kind of like 150 to 160 area on the yen. And the yen is definitely the cheapest it's been in a long time. There's been huge travel to Japan. It seems like everyone I talk to is planning a Japan trip. I have relatives there, so I'm not too happy about it because it means that everywhere is going to be crowded. But beautiful country. Check it out if you have a chance. But let's watch this yen chart. If this thing starts gathering some steam, again, that's probably going to create some global volatility thanks to the yen carry trade. But it could be interesting for returns in the Nikkei relative to the yen also going up in appreciation. So you win from stocks and you win from currencies too. With the thought that growth is picking back up and that we're not going to go into a recession, there's been an increase in commodity prices. Could also be gold and silver. Here you look in commodities, and gold and silver are two of the top performing parts of the commodity market. Really precious metals kind of driving this higher. A little bit of an increase in natural gas going into the colder times of the year. Energy actually kind of lagging. Energy's not seeing a big move. Well, I guess that's good news for inflation on that front. So let's go to rates now. We can see it's been pretty volatile. 2023, we started off with the sell-off. We got a big rally into the September when we were kind of near peak bullishness. It's got another sell-off into the end of the year. It's been this wild ride for bonds. If we look at the 10-year, we basically broke through the 2023 highs of 470, but caught a bid. So for now, we seem to be holding these levels. I think we're going to be range bound here. So there'll probably be decent resistance up at that 470 area. And I think it's going to be hard to break through this kind of 440 area on the 10-year. 440 was like the previous kind of ceiling before we broke up. And I think you'll see some support there. Looking at returns last year for fixed income was looking good. And then we got that sell off at the end of the year. So anything with duration kind of suffered. You can see the ag only up 1.3%. Higher quality treasuries up only 60 basis points. Agency mortgages up 1.1. With spread tightening, investment grade corporate bonds doing a little bit better, up 2%. But credit and floating rate was the place to be 2 years in a row. Continue to see strong returns out of floating rate things like CLOs up 7 to 12% for AAAs and BBBs. Levered loans up 8-9% for the index, 8% for BBs. Even more for CCCs, up 12%. CMBS, the laggard last year, BBB CMBS up 18%, almost the same as keeping up with equities. I don't have BB CLOs on here, but that was up over 20%. So credit has had a great run. Spreads were wide. We've talked about how attractive spreads were. Were is the critical point. Spreads were attractive, but as money comes back into the bond market and into funds that invest into these sectors, the spreads continue to come in. So 2025, off to a decent start. Started off with a sell-off, but now we got a rally. So if I showed you this chart like 2 weeks ago, everything was in the red, except for a floating rate. But now we've got a little bit of a bond rally. And so you see treasuries up a little bit, but riskier parts of the market doing better. High yield up 1.4%. CMBS BBBs up 1.7%. Off to an okay start. We'll see how things go. Curve continues to disinvert. A little bit of bull flattening this week, but generally speaking, seems like the trend is towards a steeper curve. It was very recently because of the sell-off in the long end, a bear steepening. But we'll have to kind of wait and see what happens with the Fed. The market's only pricing in about a little under 2 cuts right now. A few weeks back, it was almost no cuts this year. And so it's going to be really hard for that front end to come down unless we get some more data corroborating that the Fed can move more aggressively than the market thinks so right now. So you need inflation to continue cooling. You need maybe weakening in the job market. You need to see slowing growth. And right now with Atlanta GDP expectations, we're still probably north of 2% on real GDP expectations. And so in that environment, with the job market looking still strong, it's just hard to see more than 2 cuts. But that's what the incoming data will tell us. One of the other reasons that the market has stopped its expectations of cuts is that there's worry about inflation. Here you can see break-evens, especially the 2-year break-evens have come up, and I think a lot of this has to do with the tariff concerns. This shows you the spread tightening last year and this year. CMBS on the far right, again, we saw that was one of the better performers. CLOs came in a lot. Everything basically tighter except agency mortgages. Even agency mortgages down 1 basis point, but nothing like credit. And this year, you see continued spread tightening. It's a little skewed because of the scale, but for a bond to come in another 21 basis points just in 1 month in spread, that's a pretty good move. CLO triple Bs down 46 basis points. CLO AAAs down 22 basis points. So a lot of assets have basically gotten back to their post-crisis tights. We can see this is investment-grade corporate bond OAS and high-yield OAS on the right-hand side. And then lastly, my favorite slide, the what looks cheap report. There's a lot of stuff that they just don't look cheap anymore. The lower the dot, the more expensive. We've been looking at this for years now. We started in, I think, 22. We started looking at this chart. And the risky stuff, the dots were further to the right, which means the credit curve was steeper. And there are more dots higher up on this chart, meaning that the spreads were cheap relative to their history. And what's happened is that first investment grade corporate bonds and high yield made their way down along with EM. And our thesis was that everything else would play catch up, especially as money came back into actively managed pools of capital that invest in these non-index sectors. That is happening. If you look at fund flows into mutual funds and especially ETFs, they're coming back into fixed income, and the spreads are coming in with not just money manager demand, insurance demand, bank demand. There's all sorts of demand coming back on the market. When everyone was a seller in 22, spreads went wider. You take all the sellers, you turn them back into buyers, and spreads go tighter. It's the flow of capital, I think, one of the biggest drivers of spread. So there is still relative cheapness in mortgages, both CMBS, non-agency mortgages, and agencies. And I think that those markets will continue to tighten absent some big volatility. We could see a little bit of widening just based on kind of supply. There's a little bit of buyer fatigue in the RMBS market. Spreads widened a little bit this last couple of weeks, but I think the general trend should be down. The one thing is that there is more correlation with high quality non-agencies and agencies. So to the extent agencies stay wide, it's kind of hard for non-agencies to just tighten in a vacuum. You need banks to come back to the agency market. They've started to nibble as they've started to buy. Deregulation and Basel III could be a great catalyst to get more bank activity. So that is January in a wrap. Good luck out there. It's going to be not as easy, I think, with equities, with high valuations, with spreads very tight in some parts of the market. It's definitely a little more challenging out there. We're going up in quality in our credit portfolios. And we're staying patient here, and maybe we'll get some things shaken up and will give us some buying opportunities. So good luck out there, and we'll see you next time.